Every quarter, the world would hold its breath for that subscriber number. Did they add enough new customers? But in 2022, when subscriber growth suddenly stalled and even declined for a quarter, the music stopped. The stock cratered. It was a brutal wake-up call. And Netflix's management, to their credit, listened. They executed a dramatic and successful strategic pivot. The new narrative, and the one driving the current rally, is profitability and free cash flow. Netflix is no longer burning cash to fund an endless content war. They've become a cash machine. In their most recent earnings, they reported a staggering multi-billion-dollar annual free cash flow. They've even initiated a meaningful stock buyback program. This re-rating of the stock, based on solid financial metrics rather than hype, is the bedrock of its recent performance. It's a classic case of a company graduating to its next phase, and investors are willing to pay a premium for that stability and proven execution. The second reason is the direct, tangible success of initiatives that seemed risky just a year ago. Together, these two moves demonstrated incredible operational excellence and proved that Netflix still has powerful levers to pull for growth, silencing critics who said it had saturated its market. The third reason fueling the rally is a combination of strategic mode expansion and renewed Wall Street confidence. Beyond core streaming, Netflix is quietly building formidable competitive advantages. Its push into gaming, while still early, is a long-term bet on engagement and intellectual property. By bundling games with a subscription at no extra cost, they increase the perceived value of that monthly fee, making customers less likely to cancel, a concept known as reducing churn. Furthermore, their live event strategy, with standout successes like the live sports adjacent the Netflix Cup and major comedy specials, is proving they can capture real-time audience attention. Something that was once the sole domain of traditional TV. This diversifies their content portfolio and opens new advertising opportunities. Now, couple this with the visible evidence from the first two points, and you get the final catalyst: analyst upgrades. Major investment banks and firms have been consistently raising their price targets and ratings on NFLX. When analysts upgrade a stock, it forces large institutional funds that are mandated to hold highly rated stocks to buy in, creating a powerful tailwind of buying pressure. This isn't just opinion, it's large-scale capital reallocation based on improved financial models. The sentiment on Wall Street has shifted from skeptical to bullish, and that sentiment, backed by solid results, is a powerful short to medium-term driver for any stock price. Now, with all this bullish news, it's tempting to think the ride will never end. But a responsible analysis must address the risks and the big question: is this rally sustainable? Let's talk about competition. The streaming landscape is still brutally competitive, with Disney+, Max, Amazon Prime, and others all fighting for wallet share and attention. Content remains king, and it is eternally expensive. Netflix must continue to produce global hits consistently. Furthermore, the low-hanging fruit from the password-sharing crackdown will eventually be fully harvested, meaning that subscriber growth will likely normalize. The future growth will have to come from price increases, ad-tier adoption, and expansion into new domains like gaming. The valuation is also no longer cheap. At these elevated prices, NFLX is pricing in near-perfect execution. Any stumble in future earnings, any sign that ad-tier growth is slowing, or a content dry spell could lead to volatility. So, while the current reasons for the rise are fundamentally sound, investing at the peak always carries risk. The key for Netflix will be to continue demonstrating that it can grow profits and fend off competition through innovation, not just cost-cutting. Before we conclude, a critical disclaimer: this video is for informational and educational purposes only. It is not financial advice, a recommendation to buy or sell any security, or an endorsement of Netflix as an investment. Investing in individual stocks, especially in the volatile tech sector, carries substantial risk, including the potential loss of your entire principal. You must conduct your own thorough research, consider your personal financial situation and risk tolerance, and consult with a qualified, licensed financial advisor before making any investment decisions. Past performance, as we've discussed, is never a guarantee of future results. The stock market is unpredictable. To wrap up, Netflix's recent stock surge is not a mystery. It's a direct reward for a company that successfully navigated a crisis, pivoted its business model, and executed flawlessly on new monetization strategies. The rise is built on a new narrative of profitability, the proven success of paid sharing and advertising, and renewed confidence from the professional investment community. Whether you're an investor or just a fascinated observer, this case study offers a perfect lesson in how markets reevaluate companies based on execution and financial maturity. If you found this deep dive valuable, please give the video a thumbs up. It genuinely helps support this channel's independent analysis. Subscribe and hit the bell for more breakdowns of market-moving trends. And now, I'd love to hear from you. Do you think Netflix's current strategy makes it a long-term winner, or are the competitive threats still too great? Let's discuss in the comments below. Thanks for watching.